Power Chart Patterns Part 2, half-day intraday charts. We're going to start looking at some of the pre-market chart cups, trends, and open gaps that you'll see regularly, and how to trade these. What are some of the things that you want to look for? Let's start off with some quick examples here. Pre-market chart cups, trends, open gap patterns, and so forth. Let's take a look here at NVDA. One of the things that we want to look for first is cup patterns, and again, we have cup patterns both in the regular session as well as in the pre-market, and you can see these typically by some of the trades going off earlier from 8:30 till 9. What you really want to pay closest attention to is the trade activity that goes on between 9:15 and 9:30. What are the buyers or sellers doing? What's the bias going into the open of the market before the market opens? Here you can see it's a sharp uptrend. Buyers are lifting the stock from 82 to 82 and a half here from 9:20 to 9:30. Got a bit of selling on the open and a second cup pattern which broke out nicely for a 2-point gain. You can see on a 2-day chart pattern here, this is that small area that we just looked at zoomed up close. Here's our previous day, here's our current day, and what you want to look for again is a cup pattern, especially the right side of the cup, in terms of what kind of activity is going on in the pre-market as we get closer to the open. The other thing to look for is trends. Are we in an uptrend or a downtrend? Here you can see the pre-market actions clearly. An uptrend from 9:15 to 9:30. We see buyers were in charge of the stock, and it got lifted from about 38.5 up all the way to 39.4. So that's almost a 3-point improvement in the price pre-market during the 15 minutes before the open. So you want to be able to take a look at this and see what's going on. Put it in perspective. Here's the 2-day chart pattern. Our open is right here on 9:30. You can see that we got a small gap up, and then we got some buyers into the open, and that continued on up. So this gives us an initial bias, whether it's to buy or sell stocks in the pre-market, because you want to see if buyers or sellers are in control. Which one? That's your decision as a trader, is either to buy or sell or hold, right? Or wait. So you're seeing who's in charge. Is it buyers or sellers, or is there no trend? In this case, you can see a clear uptrend in the pre-market chart pattern. Okay, let's take a look here at open gap patterns, and there's two different types that you can identify, and the way to start off with these is with a 2-day chart. Let's take a look here at Vitesse. Open gap patterns can be either, like I had before, the wide range or narrow range. Your gaps will gap either within the previous day's trading range or outside of it. In this case, you can see Vitesse, the high here is about 20.7. The lows at 19.35 or so. The stock opened up here at about 20 and a half, made a cup pattern. This is within the previous day's trading range. The strongest signal, again, is always over the previous day's high. So this gives us an initial estimation of whether buyers or sellers are in charge. You don't want to get caught in a gap and trap, so you don't just buy a gap up, whether it's within the range or especially if it's a high out of range gap up, but you want to rather wait and see if the trend continues into the open. Okay, so that's an example of Vitesse, and you can see here, sure enough, we got some buyers here, sold off right on the open, made a cup pattern here, and gave us our breakout entry over 20.7 or so here, right around 9:50 going into 10 o'clock. We'll take a look at a couple more examples, because this is important. I want you to understand this. It's one area that's not covered by most of the other resources out there for traders, and so I wanted to spend a bit of time on it. Here you can see another example. This is BRCM, a good chip stock to trade. Here's an example of, again, a stock that's made an open gap up within the previous day's trading range. And again, these are really nice because it gives you a real clear pattern entry here over the previous day's high. BRCM, here's the 2-day, and here's our half-day close-up chart. You can see that clearly, again, buyers are in charge. The stock's moving up into 9:30. You can be, cautious and wait to see that you get a confirmation, continuation of the trend after the first 10 or 20 minutes or so. But again, it moves up sharply, gets a bit of hesitation here at the 10 a.m., continues on up for a bit, and then goes into a range. So again, these are good patterns to be able to identify is whether or not the stock is gapping up within or outside of the previous day's range. And then if so, not just where the direction of the gap is, but do we get a bull cup pattern or is it a bear cup, and what kind of continuation signal do we get for an entry point. Here is an example, NVIDIA that's gapped up outside of the previous day's trading range. You can see here clearly the previous day's high is here. The stock's gapped up over that. It's gone into a consolidation here in the pre-market. The first entry is in a cup pattern breakout over this 82.5. We can zoom in on that on the half-day chart. And here you can see, sure enough, here's the consolidation over 82.5, 82.6 or so. We got buyers in charge, lifted the stock up nicely all the way up to 84, which is a nice almost point and a half run before we get a retracement and consolidation, and buyers continue on into the morning. My trading style, I'd be in the 82.6 or so and out maybe 83, into the low 83s, like 83.4 or so on a trailing stop that gets taken out. Okay, let's move on. I want to take a look at bullish and bearish cup patterns and identify some of the things that you can see to clearly identify these. They're really important to recognize and trade. When you're trading these, you don't want to chase it 3 or 4 spreads out of market to get a fill. If you miss it, then just wait for another stock or another entry, maybe up above the next whole point entry, that kind of thing. But don't chase it and buy. Say if your target was to enter at 82.6, don't enter at 82.9 because you get a bad fill. That's not the right way to day trade. You want to either get it and get your fill routed properly. To do this, you want to make sure you're watching time and sales closely and that you're familiar with direct access trading and order routing, and make sure to know how to route, whether it's with the Super SOs or one of the ECNs like Island. Personally, I like trading with Island a lot, but I'm not averse to SOsing a market maker or going on Enka if I'm not able to get a fill on the inside 1 or 2 levels with an island bid. Okay, anyway, so let's take a look at some of our bullish and bearish cup patterns. Let's look at Brocade, BRCD. Again, we have a clear cup here in the early part of the session before we get over a 2-day high. Let's take a look at the cups on the way up. Let's say it's, we can see the pre-market, we had a cup. We have a second cup here, about 9:30. We get our first reversal around 9:35, 9:40, going into 9:45. So that would be a first entry. There's a second cup here, could enter there. You get a third cup here. This one would go up a bit and then pull back, so that might produce a stop or a small win at best. And here would be another strong cup pattern on the way up and then out. Again, each of these trades would be 10 to 15 minutes in duration. You can see this is 9:30, 9:45 here, 10 o'clock, 10:15, 10:30, 10:45. Many new traders are far too slow, and they'll sit there and wait until it's 8 minutes into the run and then enter and then get stopped out or get wiggled out or something. You don't want to wait too late. You want to enter on the first breakout quickly, and to do that, again, this is why, one thing I found, just as a side note here, in becoming more successful in my trade entry calls and so forth, I spent a lot more time in pre-market technical analysis work than I did before. I shift my focus and energy to identifying where I should be a buyer or where I should be a shorter of a stock, depending on where it's moving in the session. So by the time the stock moves there on level 2, I'm not wondering whether or not I should enter or chase it. I've already made that decision before the market even opens. This is a good example. Stock Brocade, BRCD. Our range was 31.5 to 34. Now, using my technique, pop quiz, where would you be a buyer of this stock? And also, where would you be a shorter? Let's say our market, it's, let's say this is what it looks like, and it's 9 o'clock in the morning, and we're trying to set our alerts for whether or not we're going to buy or short this stock. Where do you buy and where do you short? Well, typically, again, I look to enter outside of the previous day's trading range. Okay, so, and I like to use a half a point over the previous day's high as a buy signal. Okay, in this case it's 34.5, and that would yield. For me, again, I'm probably in for 10 minutes, 12 minutes max, so I'd be out here. I'd be in at 34.5, out at say 35.3 or so. That would be the length of my day trade. It would last, if you look on a close-up chart here, say 34.5, in at say 9:50, I'd be out here at 10, no later than say 5 after 10. I'm in for maybe a 10 or 15 minute trade max. Okay, so that's our buy signal, 34.5. If the market were to have sold off and a gap down and so forth, our short signal would be down here if it loses the 31.5 or 31.4, something like that. So long if it gets over here, short if it gets down here. That's my core trading strategy. And cup patterns, again, you just want to look for repeated cups. This is where it sells off. You don't ever try and guess whether or not there's a bottom here, except for special circumstances where stock is tanked. And typically I like to only look for bounces if the stocks move down more than 1.5 or 2 very rapidly, and then you see a volume reversal in time and sales where people are covering their shorts and that spurs in new buyers, and then I'd enter. But on these typical types of trades, you don't try and guess at bottoms. You wait until it makes a new high over the previous high, which defines our cup and a handle here and gives you a breakout long. And you trail a stop, and as soon as that stop's taken out, it may be way over here, but you're in for a good trade. Your trade duration max would be, say, this long. So in from say 36 up to 36.8, or even as late as 36.5 out at 37 or so. So that would be one example. So these are bullish cups. Let's take a look at a bear cup. This is selling pressure. Look at our 2-day chart. You can see the stock gapped up to near the previous day's high. Okay, gapped up there. It made a bear cup. The short signal would be when it loses the right side of that, and a reversal long on a bullish cup on the way over. It's all like a sine wave, and you're trading within the reversals. You can see here a pre-market bear cup. This is where it goes up, it goes over, it gets selling, and our short signal is down here once it continues selling, and you trail a close stop. This particular chart looks rather choppy, so this one would be a bit more difficult to navigate. But I want you to understand the bear cup pattern. Get some buying. It may go flat for a bit, or it may get buying and then drop rapidly. But the point is, it looks like the letter A or a inverted U. It's a saucer cup that's turned upside down, and you look to short when it does that. If you were long for any reason earlier, of course your trailing stop would be no lower than the previous low, but this would be a short trigger here. Okay, well, let's move on. Third bullet point, trading the open. Chart patterns to know for the first 30 minutes. I want to go over a quick encyclopedia or playbook of some of the ones that you want to be familiar with. First of these is simple, I call strong runs over the 2-day high. And you can see here an example. Our chips did well today, August 1st, 2001. It's a strong buying day in our semi or SOX indicator, and we had plenty of strong runs and momentum in our chips. Nice uptrend on this one. And if you look at our buy signal, it's over the previous. This is a 2-day chart. It's over the previous day's high. We wait for the cup and get in long here. There's another cup here. You get in long for a second trade. And then as soon as it starts to sell off, you have a trailing stop here, and that would take it out at, say, the 58.3 from an entry at 57.5. And that gives you a, 0.8 win. Okay, that's almost a 1-point win on the stock for the second long. First long for faster traders would be here, going into the 10 o'clock, run it up till, say, 10 minutes after. So that's our first of several different chart patterns to recognize as simply strong either buying or selling, whatever the strong direction is on the open over the 2-day high. And that's example KLAC. Let's look at PMCCR. This is a 2-day chart. So this is our open right here. And again, for me, I say that this area right here is a low probability for longs, because frequently you'll get one of these things. You see a double top here, it reaches resistance, fades, reaches resistance, fades. Okay, I'm not going to bet against the trend and try and enter right here, because this is right under where we've seen a reversal on 2 previous occasions in the previous session. So what I'm going to do is wait for breakout up over here, and this tells me that buyers have finally won the battle and they're taking it over resistance. If you look at a close-up of this open right here, the half-day chart, you can see very clearly not just the cut pattern, which is real obvious and yields an entry at say 31.4, 31.5, that kind of thing. Trail it on up to the 32 and take your half point here. But also we have a triangle pattern here. This is kind of a cup, and you can see that these often make a triangle where you're getting closer and closer to the apex here, and it finally breaks out. And so if you're trading this stock and we're in real time, this is our open and the stock's doing this, you're saying to yourself, well, this is the previous high established in pre-market, so I'm not going to buy until it gets over that. Okay, looks like we got a pop of buyers here. You can see a strong candlestick right here, so that's nearing our resistance. So at this point you should have your level 2 box up, and you're looking at order routing choices and see if island's good, which is always a first choice, and if not, are you going to hit one of the market makers or one of the other ECNs? How are you going to trade this thing? Okay, it's consolidating really tightly here, which is another positive sign. This is a ascending triangle because it tells us that our buyers are slowly winning out over the sellers. The sellers aren't able to take it back down into this range here. Okay, and then we get our breakout, and hopefully you'd be in somewhere here. Okay, and if not, that's fine. You see that buyers are continuing. You don't chase it, but you try and get in here on a breakout over the resistance level. Okay, and this is around 31.4, 31.5. If you don't get a fill till up here, 31.8, then you're too late. Okay, I mean, if if the stock pattern looks like this by the time you've decided to buy, you're way too late. Okay, you're a day trader. Day traders were in at the first sign of a trend or a confirmation over a key resistance or under a key support level if we're shorting. So that's our signal. And one of the things that I'd encourage folks to do is really practice your order routing, and practice with a variety of different stocks, because some stocks you'll be more adept at routing your orders on than others, and so you might want to try several different stocks with the different patterns. As you're paper trading, you're learning how to apply these techniques. And again, you don't want to chase. If it's way up here, then you've missed your entry. The reason for your entry is that it got slightly over the cut pattern resistance. That's your reason for entry. If it's way up here, then your rationale is no longer valid. I mean, it's surpassed your entry, and people like me are selling to you up here, right? So you'd wait for a next cut pattern. In this case, you see a lot of chop here and not a real strong breakout till later in the session. So our first entry is always the best. Don't chase a stock. Look for a breakout here. Okay, and that's PMCS. So again, this is a cup and also a strong trend in the open that you can see. Goes all the way up here, doesn't violate the trend line till up here, and that would be a trailing stop out at 32. Okay, more examples. Let's take a look at Xilinx here. Gives us some real clear cut patterns to work with. You can see here's the first one, and again, if you're trading this thing real time, this is a good activity. Put a blank piece of paper or a blank chart over and see, how would I trade this thing as the day unfolds? At what point is my buy or sell or short alert triggered? And so here we get a cut pattern. Buy would be over 41.6 or so, maybe 41.7 if you get a late fill, but don't chase it past that. Stock goes on up, and you trail a stop. And again, a good way to identify where you should trail a stop, I use the red band on level 2, which is about 4 spreads out of market. If you're a technician, you can also draw a technical trend line like this and stop out as soon as that trend line is violated on the way down. This is for the longer term, longer round trip trades where you're looking for maybe a 15, 20, 25 minute round trip. Okay, so that's a Xilinx example. Another one on a bear cup is IDPH, and that's a biotech stock. You can see this thing's been making lower lows, and this is in the same day, so this is why understanding your sectors is important and looking for the outlier stocks, the ones that are doing something different than the rest of the market. You see this thing is making a number of bear cut patterns, making new lows. Buy trigger here again is always, say, half a point under the previous day's low. Rather for the short, the buy trigger is a half point over the previous day's high. You can also play intra-range, and we'll look at these later in our Fibonacci and other retracement, bounce plays, and bottom fishing and so forth. But for our basic plays, I want you to get exposed to this. This would be our short signal here once it loses 53.5. So that's in here. Maybe difficult to get an uptick to short into, but again, you don't want to chase it. This is to show you this is a bear cup pattern. It's showing us that sellers are taking over, and our trigger, if you can get a fill on a short, if you can get an uptick to short into, would be down here. And our cover, again, if we're drawing a trend line, is once it violates that trend line. So that would be an example of a bear cup. And the final thing I wanted to look at for the first 30 minutes trading is our pivots. And we can see some nice examples here. One of our most actives, Dell. I typically don't trade this for the same reason as Intel. The range doesn't tend to be as wide, even though it's improved in the last month or two on Dell at least. Other ones that fall into that category would be Sun and Cisco, Microsoft, Intel, those types. They're most actives, but typically not most volatile, so not as much interest for day traders. We see a sharp pivot here, and we'll look at volume reversals using this as an example in a bit. But you can see one thing to look at is our 10 o'clock. It tends to be, like I said, a reversal time or pivot time frequently in the market. So we want to be aware of that. And you can see this was sure the case for Dell. At exactly 10 o'clock, we topped out and sold into a retracement or Fibonacci about half the range of the stock on the way up. Another example is in eBay. Just want you to be aware that we see pivots in the first half hour. And again, these occur typically every 10 minutes or so from 9:30 till 10. You'll see a pivot, usually 9:35, 9:40, another one around 9:45, 9:50, and then frequently 10 o'clock or 10:05, we establish our major trend for the day. And the next pivots would be 10:30 and then maybe 11:15, 11:30, then 12:30, and then so forth. So the pivots, like waves, are much faster oscillations in the early part of the session, and then it gets slower the later on in the session you go. So if you're trading the exact open, say you're in at 9:32, 9:33 on a trade, you need to be prepared to be out of that thing by 9:40 usually. You want to trail a close stop, and then if that stop gets taken out, then you've captured the most profit you can for that particular run of the stock in that time window, right? So you can see we have some pivots here. And again, this is our 10 o'clock range right here. You see 1, 2, 3, 4, 5, 6, 7, and then 8. So it's 8 different waves. I'm not an Elliottician. I don't go for this 5-wave stuff. What I look for is our oscillations in the market during the first hour and a half. I do most of my trading 9:30 till 11 or so. 9:40 till 11. Tuesday, Wednesday, Thursday is the prime time for day trading for me. I find the markets are most volatile on those 3 days. The only additions to that would be Triple Witching Friday, the third Friday of the month, and then that last week of each quarter, and especially the last day or two of each quarter when the fund managers are doing their window dressing. That tends to drive up our volatility too. Okay, so those are some of the first 30-minute patterns, our strong trends, the cups, the pivots. And now let's take a look at volume reversals. These are important to know as well, and stochastics and other breakouts. We'll do a little bit on the trend, and then we'll go into candlestick chart patterns. Volume reversals. Let's add volume to the chart. And we'll use Dell as a first example. Okay, everybody can see the volume bars down here. What you're looking for is outlier volume bars, things that are significantly above or below the stack. And these are frequently caused by institutional block trades going off. You can see here at 10 o'clock exactly, we had a large trade occur, and at that point the market pivoted off of its uptrend into a downtrend. So if the lesson learned is if you're in a trade here and you see a large block or a large increase in volume, that frequently accompanies a change in the trend, and so you want to be careful and maybe trail your even closer stop on the trade if you're open, if you're into it. If not, then you want to look at that as an opportunity for volume reversal in the counter direction frequently. You want to be in the trend on the increasing volume, but if you see a large block, you see a large volume reversal start to occur, that should be a warning sign to you if you're already in the position. Another example, let's look at RFMD. You can see here we have a lot of volume on the open. This was initially buy volume from 9:30 to about 9:35, but then you see this large volume bar here, at which point the stock price moved down, 29.1 to 28.7. So that was a half-point drop following this large volume bar. So just be aware of these volume bars as being things that often foretell a change in direction of the stock. And you want to not be on the wrong side of those when they occur. So correctly, stochastics, just briefly, there's two lines that you look at down here. The signals are when they cross over, losing the 80%, and that generates a sell or short signal, or when they cross over and they're coming up over the 20% line, which is a buy or go long signal. Only problem with stochastics is that they're not 100%, so I use them only as a secondary indicator, and usually I use them to help me get out of a position. They're kind of a red flag. If there's a crossover, things are headed down, then that's a confirmation to get out. I don't use it as a trade decision criteria to get me into a trade, so that's one thing to be aware of. An example here with PeopleSoft, you can see typically, again, stochastics are used as an oscillator indicator to help look at reversals or pivots. You can see here is where they're crossing over and they're losing the 80%, and PeopleSoft pivots at that point too. So that would be telling you if you weren't already out on a trailing stop, which in my strategy would have been the crossover stochastics losing 80% is kind of a confirmation you should be out. That also could be a short entry trigger. Let's see, you can see here on the reverse side an example of how they yield or generate false signals. Here they are coming back up over the 20%, which would tell you to buy if you were strictly using stochastics to trade with, but it was only good for 0.2, so it's not a good trade entry. Same thing down here, they crossed up over the 20%, but you can see here it didn't really go up too much. So again, I use these primarily to help me get out of a trade, not so much for trade entries. Another quick example, here's Qualcomm. Where's our first sell or short signal? It's right here as these two crossover. You can see the crossover here, and they open, and they're losing 80% here, and that corresponds with the drop in the stock. Here you can see a crossover to the upside. First one wouldn't have worked out, but the second one did, kind of thing. And over here, a crossover to the upside over the 20% also led to an increase in the stock by a bit. Again, I use these more to help me get out of a position or time an exit rather than to decide whether or not to buy or short a stock. It's just a confirmation. Here's another example of how they don't really work as advertised. You can see they cross over above the 20% here on two different occasions, but the stock, this is VeriSign, on August 2nd, didn't go up too much. So you don't use these to decide to get in, but rather, like with the PeopleSoft exit, it helps you know when to get out. It's a secondary confirmation for an exit. Okay, let's take a look at the trend and how to use that. Just briefly, it's a very useful indicator. You can see using a line chart. I get a number of questions about using the NASDAQ trend. It's not the same as NYSE trend, so you have to use the trend on eSignal. It's $TRINQ. You should check with your data provider to get the exact symbol if you're using a different program. Basically, the trend's a short-term trading index, and it measures a ratio of buy-sell volume and advancers, decliners. And if it's at or above 1.0, that is a bearish sign. If it's headed higher, then that means that we have more selling volume in the market. So it's kind of an inverse indicator. When you see the trend go up like this, see the composite index go down. Okay, so it's a inverse indicator. Generally, you look at two different things. One is where is the trend trading at, and if it's down under say 0.3, 0.5, and trending downwards under the 1.0, then that's a buy signal. It gives you some comfort on a buy. But if it's trending upwards, and especially if it gets over 1, then that tells you that sellers in the market. So that's just something to be aware of. Here you can see the NASDAQ trend on 2 different days. This is a 2-day chart. Traded pretty much flat here, but overall it was under the 0.5. It was down here at 0.2, 0.3, and that's a very positive market sign. You can see, sure enough, our composite was running during that time. It was went from 2045 up to 2075, 2080 before fading in the afternoon as usual. And so it was a strong day for the trend. In this trading session, this was a pre-market gap. It didn't trade this way. This is where our market opened, was way up here, and it sold off from the open. And you can see the trend is exact opposite. You can see it's been climbing steadily, and it broke over 1.0. So that was a bearish trend. So just be aware of that, and also that the trend reverses, and you can use that also as an oscillator indicator.